Welcome. Thanks for joining us here on Market Call. I'm Morella Fernandez. Derek Warren on the show today. He's Vice President at Lincluden Investment Management, taking your questions on REITs today. Here's how to reach us toll-free, 1-855-326-6266 if you want to dial in. You can also email your questions, marketcall@bnnbloomberg.ca. Derek, thanks for coming in. I'm going to ask you first off what the status of REITs are right now, if there is sort of a status for them. I'm wondering if they're rebounding, is there movement? It's been a very weird time for the markets.
It has. The markets in general have seen a lot of volatility, as we all know. A lot of that's thanks to our friends down south. But what we've noticed over the last little while is a normalization that's happening. That's kind of the theme we're going. REITs are becoming normal again. REITs were never... It was nice, of course, when everything was going great. Interest rates were almost at zero and the value of real estate was spiking. That's not what you really want, though. Real estate's supposed to be a store of income where you get your monthly rent checks passed through and the REITs manage the real estate for you. You kind of get 6-7% yield and a couple percent growth that gets you close to your 10%, and you could count on that year over year. So there has been this volatility, but with the correction in REIT prices that's happened, the yields are now back to normalized periods. And despite of the things that are happening in the economy, we're seeing things being quite stable in the real estate market at this time.
Okay, are there certain sector-specific REITs that you tend to gravitate towards?
Yeah, indeed. So we're always monitoring our subsectors. And for example, the retail space right now was very challenged during COVID. Stores work better when they're open, strangely enough. So when you shut down a large part of the economy and don't even allow people to go shopping, well, clearly that affected
things. And some didn't come back, right? Some just did not make it through.
That's it. So what's happened now, there's been that purge where the weakest tenants have gone. Everything's back open and running. That's been refilled with better tenants. There hasn't been any new retail built, right? Yet we added a huge population boom to the country through immigration. So things are actually doing quite well in that sector, and we're seeing that come through in the numbers.
The population immigration has been scaled back, of course. I'm sure that's taken a hit, if not at the retail level, at least at the rental level across the country?
Yes, we really saw that in the apartment markets. And a lot of that was our friends. If you remember the movie The Big Short, everyone thought, oh, we can short Canada because it looked expensive for a certain time. But our immigration was so strong that that just didn't work. However, a lot of American investors, when they saw those immigration numbers dip, they fled. And we think that was a lot of that quick sell-off that happened in the apartments around those numbers. However, we actually like apartments a lot here, and we feel that the immigration blip will normalize. There's that word normal again, as we get back to more normal immigration numbers, and it's actually showing a really great entry point here.
Got it. Okay, we are going to take a quick break. We'll line up some phone calls here for Derek Warren, Vice President, Lincluden Investment Management. Again, your questions on REITs today. Here's how to reach us. We're back in a moment. Welcome back. Let's get to the questions. First one coming up here from David. He says, thoughts on Northwest Healthcare Properties REIT. So Northwest Healthcare Properties, just pulling it up now. It's fairly affordable. And what's your take on it?
Yeah, so this is an interesting company in that it focuses on properties that are leased to the medical community. This could be doctor's offices or also hospitals. Now, we haven't been recommending this REIT in the past just because it does it's not very focused in that it has properties in Brazil, Germany, Australia, it had in England, US, Canada, all in a relatively small company. So that's kind of hard to maintain, and there's a lot of moving parts with that. So we're watching this now. We like some of the changes that they've made, some management changes, fixing up the balance sheet. We like that. Now, they do, just in these days, one of their largest tenants in Australia is going through bankruptcy proceedings. That's just been announced. That could affect kind of 5 to 10% of the earnings, we estimate. So there is a little concern that we have here. So while we've been watching this one, it's still on the sidelines for us right now. And we'd continue to wait to see how that Australian market issue goes.
So wait till it shakes out and see what happens. Got it. Okay, let's go back to the phone lines. And John's on the line. He is calling today from London with a question. Hi, John.
Hi, Morella. Hello, Derek. Longtime holder of Chartwell. It's had a good year. It's had a good run for me. Pays a good dividend. Is now the time to add some? They're quoting occupancy in the 95 to 96% range for December of 2025, and that's all profit. Or should I take a flyer on Dream Residential REIT? add to that. Thanks very much.
Okay, thanks for the question. So Chartwell would be the retirement
Sure,
homes.
we'll focus on Chartwell because that's a Canadian company. This retirement homes for our aged parents. They do a really good job of taking care of our older ones. And what's happened, post-COVID, that was, of course, a challenging time for our older ones. And since then, there's been very little development in this space, but we keep getting older and then people keep needing care. So we like Chartwell here a lot. We think that there's a continued visibility. You can see permitting of these kinds of properties that would be competitive, and it's not happening. So we still see good 3 years of upside in this name, so I would hold on to that.
Are they a company that's growing? I mean, we know there's a need there, but we have talked about the fact that the space which should be growing isn't necessarily growing. Do you see forward growth for this country, for this company?
Yeah, we do. Some of that has been developed in Quebec, and so that's where they've been growing more recently, purchasing properties there. And we will expect to see at some point a little bit of development happen. So, but at this point, the main growth is in the occupancy of the existing properties.
And those are 90% upwards filled.
Right, with a target of 95.
Got it. Okay, let's go back to Brian on the phone line. He's calling from Trenton, Ontario. Hi, Brian.
Oh, good morning. Derek, I'm wondering what you think about SGV, I think it is the grocery REIT.
Yes, Lake Grocery. Well, thanks for the question. So these are grocery-anchored retail centers across the United States, and some of our good-sized cities, not like New York or LA, but secondary cities, but those are still big cities relative to Canada. Well, we don't own this one due to the liquidity and some of the debt levels that for us were a little bit high. They have been making some really good progress on that. And yeah, especially, this is an opportunity to invest in core, basic, suburban style U.S. Real estate. And we feel that, the environment right now for the average American is actually starting to look up. So yes, this is a nice source of income.
Do you find that the REITs that are grounded in, as you mentioned, a grocery store do better than some of the other retail outlet REITs?
They tend to be more stable, and that's especially the case for the Canadian REITs due to the nature of our grocers with very large brands providing good stability.
Got it. Okay, let's go back to the phone lines. And Glenn calling today from Chester, Nova Scotia. Hi, Glenn.
Hi, Mirella. Before I say anything about a question, I'd just like to say that I think you're doing a really great job with this program.
Thank you very much. Thank you.
Okay, and my question is on Nexus Industrial REIT. I own it, and I also own Pro REIT. I'd like your guests' opinions, and thank you very much.
Thanks for the question. Nexus Industrial.
Yeah, both those names are great names. Looking at especially in Eastern Canada, Nexus, looking at the industrial markets. Industrial is one of the more economically sensitive industries. So the leases are kind of 5 to 7 years. So a lot of it's counting on shipping, manufacturing, Amazon goods and things like that.
And how are they doing in the climate right now where these on and off tariffs are sort of starting, stopping industry?
Right. So that's creating a bit of fear and opportunity in the industrial markets. So while we don't own Nexus, we've focused on some of the other industrial names. There is some opportunity that's happening here as we think the stocks have come off too much. The situation is not that bad. We're still renting out, and we still have a good industry here in Canada, and I think that actually might be growing as we go back to buy Canada. So
let me ask you, I'm looking at the Nexus line chart here, and of course it dropped around the 2022 mark, and then we didn't know what the comeback was, and then in 2025 it sort of went up and gone down again. I'm presuming that's the trade war. So it is down to like 726 at this point. Would you pick it up at this point, or do you think it could sink a little bit more?
The risk is the recession. So that's why there's this kind of unknown time right now. And I would argue that it's very hard to predict. I'm not in the business of predicting recessions. However, if there is one, this is one that would be hurt a little bit more. If you think we're going to skate through, then now is the time to be picking some up.
Got it. Okay. Let's take a quick break. We're going to stick around with Derek Warren. We're going to line up more of your phone calls for him. He's taking your REIT questions today. Here's how to reach us. We're back in a moment. Welcome back. Let's go to the phone lines. Frank's on the line, calling from Mississauga in Ontario. Hi, Frank. What's your question today?
Hi, my question is for Minto REIT. I'm looking at the key statistics of this company. It has a market cap of $485 million, while the enterprise value is $1.38 billion. It has a payout ratio of 20%. 20% payout ratio. That's so low, and and insiders are buying, and the book value is $28. What am I missing in this stock?
Is he missing something?
Well, it's a good question. So what you're missing, Minto is a great company, and we do like this company. It's very good management, backed by a large developer. The concern in the market right now is that while I'm bullish on the apartment market, the condos, of course, are emptying out. So the condos are facing pressure. Now, condo rentals are very expensive. They don't really compete with your average apartment building unless it's a brand new apartment building. Now, Minto happens to have some of the newest apartment buildings. So the view of the market is that they're going to compete more with this distressed condo market. And as such, some of those rents are going to see downward pressure at a greater clip than some of the less expensive rents, some of the names we'll talk about later.
I just wonder, because I'm looking at the Minto line chart as well, and it started tapering off last fall. Do you think that's when you started to see that big sort of condo emptying out?
Yes.
And nobody taking ownership or not being able to rent it, and then the Minto stocks
and we have
fall?
condo supply for the 2026 and into 2027 that's going to continue to put pressure on those rents, on those high-end rents. However, we feel some of the mid to lower range rents will actually recover quite well.
Got it. Okay, let's go back to the phone lines. Gordon on the line from Victoria today. Hi, Gordon.
Good morning. SmartCentres REIT, with Walmart as their anchor tenant, is Walmart's ability to draw other high-paying tenants to the centers enough to overcome the long-term leases that Walmart has negotiated with tiny little annual rent step-ups?
Okay, so Walmart, great
Yes.
Great to have on the block.
It is, and they attract a lot of attention. Now, it's correct that they don't typically, have large increases on that space, but they do attract enough of a following around of other tenants, and that's where you get your rent increases. Now, I'll say some other positive things about SmartCentre. One, they are doing new leases with Walmart, as Walmart has announced expansions, and some of those leases are actually giving some rent steps, so that's a positive for the future. On the core, they do have very large parking lots. If you've ever been to these SmartCentres, to a Walmart, some of that's going to turn into other properties. It's going to turn into rental apartments, storage, some seniors housing perhaps. With all of that potential for growth, I would argue, I believe somehow in the next 5 years, Canada's going to see a housing boom. We're finally going to get out of our way. And when that happens, you're going to want to find well-located places of land. And that's what SmartCentres has. So I think there's some great potential to collect the yield and wait for that housing growth.
Got it. Okay, let's go back to another phone call. Mike's on the line. He has a call. He's calling from Vancouver. He is calling from Vancouver. Hi, Mike. Mike, are you there? Okay, so I feel like we've lost Mike. His question, however, was on Dream Industrial REIT.
Yeah.
So tell me about Dream.
So we talked a little bit about industrial. So Dream in particular would have more of a GTA focus and also some European assets. So we're reliant on the economy once again. Now, there was this huge boom, of course, in industrial as we all started to buy things from Amazon. So you need more of these warehouses, and then there's more shipping that's going around. And then, of course, the problems in COVID where there's nearshoring. We had shortages, so people increased their warehouse space. So all of those are kind of over. So what we're seeing is rents that went from a peak of too expensive, now coming back to, let's say, from $20 down to $14. Now, in the old days, rents were $5. So they're still triple what they were. They're just not quadruple. So the market's come down as they're saying, oh, it's not growing as much. But we actually like it here because it's still growing very well. There's still a number of leases that they'll be turning over the next couple of years that are at, let's say, $7, and they're going to be doubling to the $14, $15 range. So you're still going to see steady growth. And we think Canada kind of pulls through and that there's not going to be a recession is my hope. Once again, if we do hit hard recession, industrial REITs in general will have a bit more pain. I just don't think that's my base case.
So if we see sort of weakness, but not necessarily a recession, same kind of thing, there could be a bit of a dip, but they'll pull through.
Correct. I believe the market's overreacting on the downside.
Got it. Okay, let's go to another phone call then. Al is on the line from Orillia, Ontario today. Hi, Al. Al, are you there?
I am, yes.
What's your question?
My question is, what long-term investments with RioCan REIT?
Okay, let's talk about RioCan.
Okay, yeah, we're big fans of RioCan. Now, it's we like what's happening in retail, as we explained, because there has been no new development of retail properties. RioCan has been going through some steps where they're increasing efficiency and trying to focus on their core strengths of the portfolio.
When you say they're increasing efficiency, what does that look like for them?
So reduced headcount a little bit.
Okay.
That's always tough to go through but they were doing things the old way perhaps, and they realized they were overstaffed as technology has picked up. It also means that they had expanded into developing apartments, which is a non-core part of their business, and so they're selling that off and focusing on retail, which they do very well. Now, I think we're going to be talking about Hudson's Bay Company in the future. They are somewhat affected by that, so we'll specifically talk about that as a separate theme. But we still are very positive on the way that they're going to be able to continue to grow earnings over the next few years.
Okay, and is RioCan across Canada?
Yes, it is.
Okay, so they're right countrywide. Let's go then to an email from George right now. George says he wants some information on Granite REIT. What's your 2-year earnings forecast and risks? Is it a buy or is it a sell? Granite REIT.
Right, so let's complete the trifecta on industrial.
Okay.
We talked about the other two names. Now, Granite has a unique feature in it in that more of its space is large bay, less smaller businesses, more international tenants. It's in Europe as well as US and Canada. Now, it does have leases to Magna. So Magna is the auto manufacturer. People are somewhat concerned, and I think that's why it's received some extra pressure. We view this as there's no real risk there. Magna is a very well run company, has low debt. The leases are very long term. We see their actual exposure to Magna around 3%.
Okay.
And what that means is, while it's technically larger, they could release all the other buildings to other tenants. It's just very specialty auto manufacturing plants would only be around 3%. So we actually like Granite here. We think, again, the industrial market is being punished unreasonably, and that it's showing good value for the future.
So when you talk industrial REITs, what are the top three? We mentioned the three. Are those the top three in the country?
Those would be the top three, and if I put them in order, it would be Granite first, and then Dream Industrial, and then Nexus.
Got it. Okay. Let's take another quick break. We're going to line up some more questions for our guest when we come back. We don't have past picks today, so we'll have a conversation when we come back. Back in a moment. Welcome back. We have an email we want to get to from Charles. He says, what does the Hudson's Bay bankruptcy mean for retail REITs? Will the space largely be refocused elsewhere other than retail, or will it give an opportunity for new initiatives? It's an interesting question. I'm not sure if we can answer it in fully, but it does leave a large void in pockets across the country.
It does. And so, first of all, this is not a surprise. I think we've all known that this was going to happen.
It's been going this direction for many, many years.
Sure. Now, similar to what our SmartCentres and the Walmart comment was, Hudson's Bay does pay very low rent in these legacy spaces. Sometimes there was 100-year leases at $1, $2.
Sure.
So there is upside if you can remove Hudson's Bay as a tenant. Now, all of this is still happening. The RioCan and Primaris REITs would be the ones most affected. RioCan, especially because they put some of these things into a structure that at the time created value, but now is a harder pill to swallow. So they have some more work to go through there. But there is some news that some 28 of these leases may be purchased. Now, if you purchase a lease, the conditions of the lease do say that you have to operate the same kind of store, a department store.
Interesting.
You can't buy it and put in a go-kart track, for example, in a mall.
Really? Okay.
You have to run and manage a retail store. So it'll be interesting what kind of new brands could come out of this. Canadian Tire has shown interest not only in the intellectual capital or striped blankets and things like that, but also some of the spaces.
The properties themselves, okay.
Now, interesting, because in the old days, Hudson's Bay was so powerful as a tenant, they actually had control, and they could say, well, you can't develop anything around us, you can't have any of this or that kind of store. So the fact that they're gone, many landlords are actually quite happy that, while, yes, they're going to have to pay, it opens up development of other properties or other types of real estate around where the Hudson's Bay was. So you may actually see that this is finally, while painful, like a painful surgery that you have to go through, when it's over, you are in better health. And I think that's what we're going to find for a lot of these properties.
Do you see ideal tenants for some of these spaces? You mentioned Canadian Tire as one. I know that one of the Sears stores was emptied out in Toronto, became an IKEA, essentially, like a mid-sized IKEA. So what are some of the retailers you see that could take up space?
There is a possibility. Some of those brands we've just mentioned, perhaps even Simon's would take one or two in expansion. The problem with the Bay is when it's more than 2 floors. 2 floors is manageable, but as soon as you get that 3rd floor and it's often not connected to the rest of the mall, or in some cases even more, that becomes challenging. And in those cases, the real value may be in tearing it down and building something else.
Got it. Okay. I do want to talk to you a little bit more about apartment REITs, given the situation and the changing situation we're in. So we talked about the scale back in immigration, which would lead to some apartments being empty or stalled in sort of building or permitting. What's your forward take on how this is going to shake out, given the immigration and the condo factor, which in some markets there are a glut?
Right. So right now we're excited about the apartment market again. We hadn't been for a little while, but this whole news on the immigration correction and the reduction in temporary students has put pressure. But in a way, things were too high. It's all lovely as a landlord, perhaps, if you can charge $4,000 a month or $5,000
for a studio
apartment, but that's not really sustainable. And there's going to be a refreshing kind of change here as rents are coming down, and they are coming down, where people will finally say, now I can get rid of my roommate and I can get my own place.
Sure.
Or now I can finally move out of my parents' basement because I can afford an apartment. And the secret, especially in rent-controlled markets such as Ontario, the rent value is one thing, but when you can't raise the rents on an existing place, what you need is for people to move. And people stopped moving. They just anchored down because they can't afford to move. So surprisingly, even though rents come down, if that allows people to then make that transition that they've been putting off, that rent that they're perhaps paying way, way below market, sometimes 50% below market, gets to reset to market. Sure, it's not where it was at the peak. That's okay. It shouldn't have been there. It'll go back to a more sustainable, but a bigger increase. And that's why we're bullish on the apartment REITs right now, especially on the more affordable zones and nodes across Canada.
So some would argue, why go invest in a REIT if you can invest in a condo? How would you make that point?
So for a while, people thought that condos only went up. And I think we're seeing now that that's not the case, as there are condo development projects where the condo is trying to sue the people who bought the building, bought the units, because they can't close. So people got a little bit too greedy, and I think we realized that if you're buying anything as an investment, investments can go down. We kind of forgot that when it came to real estate investing.
Sure.
And so
because historically, for the last number of years, for decades now, it hasn't gone that way. It's only gone up.
But as the interest rate, started to move and turn, and that trend ended, you can lose. Now, we say in investments, if you can't lose 30 to 50%, you shouldn't be invested. But when you're buying real estate and it's 90% leveraged, that 30 to 50% correction would wipe you out completely. Unfortunately, some people are going to go through that. But I think we'll see that normalization come back to the market, and hopefully an increase in rental product, because I know a lot of young people that would like to start renting at a reasonable rate to be able to save for a down payment one day for the future.
Got it. Okay, we are going to line up some more phone calls for Derek Warren, Vice President, Lincluden Investment Management, taking your questions on REITs today. We're back in a moment. Welcome back, and thanks for joining us. Let's go to the phone lines. Mike on the line from Toronto today. Hi, Mike.
Hello. I'd like to ask about ProREIT. It's come down and then bounced back up kind of with overall markets. Do you still like it here, or do you have a preference in a smaller name?
Okay, thanks for the question, Mike. So ProREIT, can you tell me a little about ProREIT?
Yeah, so I mean, I like ProREIT. I wouldn't go smaller. It's quite small as it is. Now, this when we talked about industrial REITs, this does have a nice industrial component in it, but ProREIT's focused more on Eastern Canada, and they have some great properties there, and that market's been very, very stable. It didn't hit the big bubble up. There wasn't a lot of New York firms running into Halifax, for example, to buy up industrial properties. So it was always more stable, and so we like that. They just did a recent transaction in Winnipeg as well. We like the Winnipeg market. And so that's kind of a theme, especially post-COVID, as people start to move to other parts of Canada because they're working online. These secondary cities, Halifax, Saskatoon, Winnipeg, are no longer secondary. They're less risky than they would have been in the past, and we like this trend here. So this is a great management team that continues to expand throughout the Maritimes, now into Winnipeg and into Quebec, with getting rid of their office exposure and focusing on industrial.
Got it. Okay, let's go back to the phone lines then. Mr. D is on the line from Toronto. What's your question today? Hello, Mr. D? Okay, I'm going to ask that. I think it's about Plaza Retail REIT.
Okay, Plaza, sticking to the maritime theme, that's great. So Maritimes in Quebec, these would be your little shoppers anchored center, nice, little bank, SAQ or an LCBO kind of idea. So this is with a liquor store. So, we love this kind of property. Now, over the years, they've been able to continuously just develop these. They're a very good management team, highly respected, and just offering really good expertise in their sub-markets. No one knows those markets better, and that's what we like, just to be a true professional, very focused on what they do. They're not expanding into trying to also be experts in other fields or other provinces.
So just
we
a
like
steady
that.
investment.
Indeed.
Got it. Okay. Let's go to an email then from Ryan. Ryan says, what are your thoughts on Primaris REIT? They have delivered solid financial results for years now, yet still trade at a higher implied cap rate than their peers. What am I missing?
Yeah, that's a good question. We scratch our heads about that too a little bit. What are we missing? Because we like Primaris here. There is a bit of concern against shopping malls in general, perhaps, that there's still, some sensitivity there to the consumer that might hold back. However, from what we see, consumers are continuing to spend money, and it's cold here. We don't always shop outside. We love our malls, and so they've actually showed great numbers. They have an excellent balance sheet, and I think they don't get credit as they should for their stellar balance sheet with very low debt. That is going to provide those stable returns going forward. Now, they do have some Hudson's Bay stores. There is some question about how they're going to manage that, but they have an excellent lease structure. Their retail team is one of the best. And we feel that it's one of those that they'll be able to, with a minimal investment of $50, $60 million, they're going to be able to actually create a lot of value from those spaces. How
much exposure to Hudson's Bay do they have?
There's 5 stores that it looks like that may be sold. The lease may be sold, and then another 4, and I may be slightly off on these numbers, but directionally correct. Another 4 that they're going to be keeping. Those are the ones that would be redeveloped, maybe knocked down, or maybe turned into a different kind of purpose.
Just out of curiosity, your opinion, because Hudson's Bay was spread across the country and they were in some, smaller rural markets and then, big cities, which of their leases would be harder to unload?
So the hardest are, surprisingly, where they had their core buildings. Montreal, Vancouver, Toronto. Some of these were 5-story buildings, very old architecture. In Winnipeg, for example, that was even donated to one of the Indigenous communities that was local, because it's hard to structure into other things. So we feel that challenging. Nowadays, we like retail on 1st and 2nd, maybe the 3rd floors, but some of these are 5, 6-story buildings. They often are on transit lines, on subways, so it's very hard to build on top of. So those are the real challenges, and I would argue that if I owned one of those, I would just write it off to zero.
Just too much space.
Just take the pain.
Got it. All right. Let's go to another email then. Julian says, considering Boardwalk is trading below its NAV, would you consider buying even though both leading parties plan to slow immigration? So again, connected to the sort of lower population growth.
Sure, great question. Now, I would argue that we're not lowering immigration. We're returning back to where we were. We're eliminating the bump in immigration. So we're going to go back to a nice stable. Canada's populations need to get bigger, and a lot of these people are going to move to Alberta, which is where Boardwalk has the majority of their properties. Now, it's not only new Canadians, existing Canadians, as a lot of Ontario is moving to Alberta. I can tell you that.
Why do you feel that that growth will take up in Alberta?
So a lot of it, the restrictive zoning that Ontario and some of our other provinces has allowed, it's so hard to build here. We're trying to build apartments. It can take 7, 8 years to get permits. And then once you build it, there's some rent control issues or fears that that true exists on older buildings, not new properties, but they limit your upside. And that's very hard to work with as a developer. You need to know what your costs are. It's going to take a couple of years to build this, whereas Alberta is much more friendly. They don't have the rent control, so you're able to adjust. So as things move around, you're able to get the income that you require from the property. And as a result, the rents are cheaper. not more expensive. They're cheaper, and there's more apartments that come up there. So we really like that model, and we own Boardwalk here.
Got it. So it's just a natural flow. You think that'll go west, and they'll allow for that in building infrastructure.
That's it. And while there is immigration trends, there also is a pro-energy trend that's going to benefit Alberta,
Sure.
and
Yes.
I think that will trump any. Sorry for the word Trump. I said I wasn't going to use that word. That will trump any of the negative immigration trends.
Got it. Okay, let's get to one more email then from Kenneth. He says, thoughts on Killam. What is Killam? I don't know Killam.
So Killam is an apartment REIT, very well managed. We own Killam, have for a very long time.
How big are they?
So I would call them. They're kind of in the top 5.
Okay.
Right. So it's a good size. They originally were focused on the Maritimes again. Once again, we love Halifax. We love the Maritime markets. I'm a New Brunswick boy at heart. So that whole market has seen a lot of inflows of population. But they've also been expanding into other markets as well, here in Ontario and Kitchener-Waterloo area. What we like about Killam is that they're one of the more experienced developers. They were developing early, make some mistakes, figure it out, learn the lessons, and they're continuously improving their portfolio. So they're able to have a very energy efficient, newer construction, but at the same time not face those high rent pressures that we were talking about with the other name earlier.
Got it. Okay, we are going to take a quick break, lining up some more phone calls for Derek. We're back in a moment. Welcome back. We have an email from Deanna that we're going to look at. She says, do you consider Melcor REIT a good buy? We'll turn that over to Derek. Melcor REIT.
Yeah, I want to talk about Melcor just because this is characteristic of the old structure of REITs where a large corporation, in this case it was family money, the Melcor Development Corporation, spun this REIT out and is focused on commercial properties in Edmonton. So the nice thing and the tough thing, but the nice thing about the real estate market in Canada is you can pick by these names different core geographical areas and then choose your investment, which is a great tool. Now, we talked about the great building that you can do in Alberta, which is good for apartments. Unfortunately, they also built a lot of office buildings right before COVID, and that was very hard on the market as a lot of those faced a lot of pressure as we all started working from home. So Melcor went through its challenges. Now, when you do have the support of a parent organization, we think that there'll be, there's this, they can take it back, privatize it, and I think that's what's happening with Melcor. And so there is that opportunity, and the question we have is trying to identify other small REITs in Canada that are struggling that perhaps may also be absorbed by parents or by other organizations. And I think you will see some of that.
Are there any transition opportunities? Is anybody doing that transition from office building to apartments? I know that was a discussion when the housing crisis sort of first came up, and it was like, okay, can we do this? Is that too challenging, too difficult, too costly to do?
It's harder than you think. The basic reason is that office buildings tend to be rectangular and, square versus rectangles on apartments. So a square, unfortunately, that would mean your apartment would be really long and thin with windows only on one end.
Got it.
That makes the challenge. Now, however, the city of Calgary and other areas of Alberta have made some efforts where they're funding some of these conversions, and where they work, they can work out all right.
Got it. Okay, let's go to another email from Ruben. He says, could you please ask your guest about H&R REIT? It's done nothing for so long. Is there a breakout coming anytime soon, especially now with rates coming down? H&R.
So I would say Ruben's not the only frustrated person with H&R, but that's not necessarily a bad thing right now. So H&R, what they're composed of is they have a large apartment portfolio in the United States that they've been purchasing over the last few years. Retail, industrial. So typically they were, known as an office industrial REIT. Now they've been selling down a lot of those kinds of properties and have been, slowly focusing on these two core markets of industrial and U.S. apartments. So as they get closer to that clean story, we do see that there'll be some catalysts, and there may be some this year. And in fact, this year into next, they have a large retail portfolio in the U.S. known as Echo Realty. If they're finally able to spin that out or sell that would make the story a lot cleaner, and we think that'll be a catalyst going forward. There is some pressure on the U.S. markets. I think the previous guest was talking about some of the U.S. apartment markets. I do have some pressure. They don't have the financing pressure. They're fine that way, but there is going to be a dip in building, and we think that'll actually provide an opportunity for H&R as they're doing some neat projects in some of the Sunbelt markets of the U.S.
Got it. Okay, let's get to another email then. This one's from Brian. Any comments on Inovalis REIT?
Yeah, Inovalis was one of these quirky vehicles that we think needs to find a better home.
Okay.
It's
what do they do?
It's French assets, so assets in France, a couple of office buildings in Paris. It's quite small. And we think that it really would be better privatized, and that will happen over time. Now, as the European market is recovering, and we are seeing some nice recovery in occupancy and in valuations in Paris, London, and Frankfurt, some of these core office markets. As in Europe, frankly, they're returning to the office much more than we are here in Canada. We're a laggard in this. And so hopefully we would like to see this taken private and put out of its misery, so to speak.
It's at $1, yes.
Yeah, the properties are fine. It just shouldn't be in the public markets. It's too small.
It's just too small to be in the game. Got it. Okay. And they only own it in France.
That's correct.
Got it. All right. Let's go to another email. This one from John. He says, what are your thoughts on Canadian Tire REIT?
So we talked a little bit before about grocery-anchored portfolio, how that can be very stable. This is similar in a way that it's anchored by Canadian Tire. Now, Canadian Tire, of course, is not just Canadian Tire. It's Sport Chek,
Mark's Work Warehouse,
which is a very successful brand here in Canada. So they have their suite of tenants that they can use. It's very well structured. You're getting nice little increases in rent over time. They didn't. We talked about those Walmart leases before, where there's no increase. Canadian Tire learned from that and said, no, we'll allow certain increases along with inflation, something that's reasonable and fair. So we really like this name. It's been very, very stable during this whole time of tumult. And I would argue that as tariffs come against Canada, even more and more of us are going to be shopping at Canadian Tire and our Canadian brands supporting the Canadian economy.
And they've got sort of a redevelopment going on, right? They're kind of changing up their stores a little bit. They're trying to pare things down, bring in new brands, as you mentioned, some of the Bay intellectual property. So they are going through a bit of a metamorphosis.
Yes, and they have so many stores, hundreds of stores. So while some are leading edge, let's just say that kindly that some of the stores could use some work.
Absolutely.
And but that's an upside. That's an upside as those refreshes get complete.
Got it. Okay. Let's get to an email from Dennis. European residential REIT is what he's asking about. Great question,
Because we've been talking about why these European vehicles in a Canadian REIT, and this is another example. Now, this was founded by Cap REIT, so they were expanding into Europe, and they used this other vehicle, and they've decided to wind that down. So what you'll see, if you look at the chart, it might look kind of lumpy, but as they're selling off these properties, in that case, that's the price chart because they dividended out, so that doesn't record the total return. There's a large dividend on that spike out that counted for that whole amount. So you've been made whole plus. And they continue to sell properties. So the question is, do you want to buy this and knowing that it's only going to be around for another year and hope to pick up some upside? Or do you want to invest in something that's being more actively managed for growth and not for being unwound? We have sold our units in European residential, taken our profits, and redeployed into an area that we think will grow going forward.
Is there a comparable that is European-based that you've looked at, or are you sticking to North America?
We're sticking to North America.
Got it. Okay. One last email here from Nicholas. He said, I'd like your opinion on Northview REIT.
Yeah, very unique group of properties. So apartments, once again.
Where do they operate?
So they'd be, some of it in our centers that you'd recognize, but a lot of it, the core portfolio is up in Iqaluit, Northwest Territories, Yukon, hence the name, and Northview. So very interesting economy there, as there tends to be more of a focus on Canada's north. A lot of those leases are pseudo-government leases, as the government will lease a block of apartments, and it's
have their employees going in and out. Sure.
Exactly. There's mining and those kind of industries. Very unique. This was existed, privatized, and now has been spun out again. So this is the second coming of Northview. We think that their debt is a little bit too high, so I'm not quite comfortable with the debt right now. But that core income will help them delever over time. We're just going to it's on the sidelines for us.
Got it. Okay, we are going to take a quick break right now. When we come back, Derek will share his top picks. That's coming up in a moment. Welcome back to Market Call. Let's take a look at Derek's top picks. His first one is Canadian Apartment Properties REIT. Tell me about why you like this REIT and what you see for it in forward movement.
Right. So, I mean, we've been talking about the apartments. There's no secret now that I'm positive on apartment market right now. And the reason we chose the Canadian Apartment Properties as our first one is due to the Canadian. It's the most broadly balanced across the country. It does have more of a focus on Ontario, but it is also involved in other markets. It's the largest, so it's the most liquid. And so we feel that it's a very easy investment to get in and out of. And what we've explained on the apartment side, what's unique with Cap REIT, what's happening now is that they've been selling the European piece that they had. They've been selling older properties that are higher maintenance. The energy costs in older buildings are quite high just because of the construction. New construction is so much more efficient. And even on an ESG component, that's a lot less carbon then that's going out into the atmosphere when you're in a newer construction build. So we love that tendency of selling off, getting the capital, paying down debt, and buying newer properties and recycling those assets. They're also buying back stock as well with the money that they have. So all of that is very positive for this name. It is with the caveat that we talked about. You're going to see the peak rents coming down so much, but what we're really looking for and the number to watch for is the turnover, the asset turnover. With an Ontario focus, which is a rent-controlled market, you want to see people finally see rents at a point where they feel that they can expand, they can move out, they can get a new apartment. It used to be 30%, 33% was turning every year. That's gone down to below 15 at the low. Now it's around 16%. We need that people to get the confidence that they can move out. And we see that happening over the next couple of years.
Do you see, because you mentioned it's going to take some time, the rents are going to come down, is it worthwhile to wait a little longer to watch before dipping in?
No, it's just so cheap. That's the thing. It's right now, investment people are fearful, and that fear that's there in the market has really pushed these REITs down to lows. For example, we're acting like we're never going to bring new Canadians into Canada again, when everyone knows that we need, our whole infrastructure requires a population of 50 million by 2030. We need to add a lot more people, and so that it's going to happen. It just won't be in the spikes that we saw over the last couple of years. So you're going to see that population return on a normalized basis. You can see normalized rent growth, which from here, let's say that's 3 to 6% for Cap REIT, all while you're getting a 3 to 6% yield as well, and on a stock that's cheap. To us, that's low to mid double-digit returns going forward.
Got it. Okay, let's get to Flagship Communities REIT, which is your next top pick. They do trailer parks in the U.S.
Yeah, so this is a little quirky. I love this company. It's so unique. So trailer parks in the U.S. Yes, this is the easiest access for a family in the United States. If you don't have a lot of money, this is the most affordable option to you. And the structure of a
is it growing?
Oh yeah, it's growing. A lot of this is growth on their own properties where there's still room to add more trailers.
Okay.
There's not a lot of permitting of new areas, but they are growing by acquisition and able to buy up other areas as well. But you own the land. The tenants or the individuals own their own home on there. So the amount of rent that they're paying past their mortgage is very small. So if you put through an increase of, let's say, 5%, which is a nice, in our world, a great increase, that's like $35. So they're able to provide these opportunities of providing affordable housing at a really attractive rate and have an earnings growth, an AFFO growth that is really strong. So while it is kind of small and unique, we think this is a really unique opportunity. It's inexpensive, and we see strong growth going forward.
Got it. Okay, we'll get to your third pick here, which is Allied Properties REIT on the TSX, yielding around 12%, you said.
Yes. So I always have to hedge this. We get a lot of calls here where people are looking for high yield. This is a very high yield. We know why. The office market has gone through a lot of pressure. People have been working from home. Post-COVID, there's been some pressures. There was some building that was the last little part of the leg that's just coming online now. And as so, they've received some pressure on their rents and on their earnings. Now, they haven't cut the dividend. I actually wish that they had cut the dividend during COVID. I think that the board made a big mistake there, but they decided to keep it. Now, they're not going to cut it now, so they say. Even if they did, I think that would be viewed relatively positively by the market. But the stock is trading at a discount. And right now, it's a waiting game of when will the office market recover. We do not think that the office market is going to get worse in our main cities, Toronto, Montreal, Vancouver, Calgary. We think that it's not going to be a hockey stick straight back up either. So let's call it a year or two of slowly, barely improving the office market. However, I'm getting 12%. I can handle flat. I can handle a flat office market if I'm getting 12% yield. As that recovers, I think you will see and this is a trend we've seen very often. When things go bad, everyone screams, oh, it's the end of office forever. Well, they used to say malls were dead, and then they said seniors housing during COVID was dead, and all those have recovered very well, thank you very much. And we see that opportunity in office gradually over the next few years.
Okay, and just for viewers' sake, it went down, started going really down last fall, so it was at about $20, $21.60. It's down to about $15.23 at this point, if you want that yield. Okay, we do have to leave it there. Thank you so much for coming in, Derek. We'll see you again soon.
Our pleasure.
And thank you for joining us here on Market Call. We'll see you again tomorrow. Here's a look at the markets as we head to a break.